You're 55. You have about $50,000 saved, and you've probably done the math in your head enough times to know it doesn't feel like enough. Here's the thing. You're not an outlier. According to the Federal Reserve's 2022 Survey of Consumer Finances, the median retirement savings for Americans aged 55 to 64 is just $87,000. Half of people your age have less than that. So the starting point you're standing on is more common than the financial media would ever admit. But common doesn't mean safe. Every year, you delay maximizing your contributions costs you real money in lost compounding. At a 7% average annual return, the inflation-adjusted historical average for a diversified stock portfolio, according to Vanguard's long-term return data, waiting just one additional year at this stage costs roughly $3,500 in future growth on a single $50,000 balance alone, before you've added another dollar. The window is 12 years to age 67. That's enough time. But only if you understand exactly which tools are available, how much you can actually put in, and in what order. That's what this video walks through, end to end. Where you actually stand. Before you can build a plan, you need an honest benchmark, not a shaming exercise, just the actual numbers. If you're 55 with $50,000 saved and you contribute nothing else, that balance at a 7% annual return grows to roughly $112,000 by age 67. That's real money, and it's a foundation. But most retirement income calculators suggest that a comfortable retirement requires a portfolio of roughly 10 to 12 times your final salary. For someone earning $60,000 a year, that's $600,000 to $720,000. The gap is real. Here's what changes the math entirely: your contribution rate over the next 12 years. This is where late starters have more leverage than they realize, because the IRS has specifically built catch-up tools for people exactly in your position. The government didn't do that by accident. After decades of research showing that Americans chronically undersave in their 40s, often due to child-rearing costs, healthcare, or job disruption, Congress built age-based contribution boosts directly into the tax code. Understanding them isn't optional at this stage. It's the whole game. Maxing the accounts that matter most. Let's start with what you can actually contribute right now in 2025. If you have a 401k, 403b, or 457b through your employer, the standard limit in 2025 is $23,500, according to the IRS. But because you're 55, meaning you're 50 or older, you qualify for the standard catch-up contribution of an additional $7,500. That brings your total annual 401k limit to $31,000. On the IRA side, the 2025 limit is $7,000 for people under 50. Because you're over 50, you can contribute $8,000. That's the standard IRA catch-up, also confirmed by IRS publication 590A. So stacking both, $31,000 into a workplace plan plus $8,000 into a traditional or Roth IRA equals $39,000 per year in tax-advantaged space. Not everyone can hit that number. Your filing status, income, and whether your employer offers a match all affect the actual picture. But the ceiling is meaningfully high. Now, let's run the compounding math on a realistic scenario. Suppose you contribute $20,000 per year, about $1,667 per month, into tax-advantaged accounts starting at 55, and your existing $50,000 keeps growing at 7%. By age 67, your $50,000 grows to roughly $112,000. Your 12 years of $20,000 contributions, also compounding at 7%, adds approximately $358,000. Total, around $470,000. Push that to $30,000 per year, which is achievable if you have a matching employer and reduce other spending, and the contributions portion alone grows to roughly $537,000. Add the original $50,000 compounded, and you're approaching $650,000 by 67. That changes the retirement income story entirely. The single most important variable in this math isn't the return rate, it's the annual contribution. Get that number as high as possible, as early as possible. The Secure 2.0 Super Catch-Up. Most people haven't heard of. Here's where it gets more interesting, and where most people in their 50s are leaving money on the table. The Secure 2.0 Act, signed into law in December 2022, added a new provision to the tax code that took effect in 2025. It's sometimes called the super catch-up. If you are between ages 60 and 63, you can contribute an even larger catch-up amount to your 401k or similar workplace plan. The 2025 limit for this age band is $11,250 as the catch-up, not the standard $7,500, bringing the total 401k contribution limit for ages 60 to 63 to $34,750 for 2025, according to the IRS. You're 55 now. That means in 5 years, you hit that window. Plan for it. If your income holds steady and you can redirect even more cash flow at 60, those 3 years of super catch-up contributions at the higher ceiling add significant additional compounding runway. One important nuance. Starting in 2026, high earners using catch-up contributions in employer plans will be required to make those contributions as Roth, meaning after tax. This applies if your wages in the prior year exceeded $145,000. If that describes you, the tax treatment of your catch-up dollars is about to shift. That's not necessarily bad. Roth growth is tax-free, but it changes your planning calculus. Talk to a fiduciary before 2026 if you're near that income threshold. What most people get wrong about Social Security timing. I cover catch-up retirement strategy for late starters, and the single most common mistake I see isn't contribution rates, it's Social Security timing. Most people in a catch-up position assume they should claim Social Security as early as possible, at 62, because they feel behind and want income coming in. The data says this is usually the wrong call. Claiming at 62 permanently reduces your benefit by up to 30% compared to your full retirement age benefit, according to the Social Security Administration. If your full retirement age is 67, claiming at 62 locks in that reduction for life. And if you delay past 67 to age 70, your benefit grows by 8% per year in delayed retirement credits, also per the SSA. Here's the math on a concrete example. Say your projected full retirement age benefit at 67 is $2,000 per month. Claiming at 62 gives you roughly $1,400 per month. Waiting to 70 gives you roughly $2,480 per month. If you live to 85, roughly average life expectancy for a 55-year-old American today, according to the SSA's 2023 period life tables. Delaying to 70 produces significantly more total lifetime income than claiming at 62, even after accounting for the years you went without benefits. The break-even point for delayed claiming is typically around age 80. If your family history and current health suggest you'll live past 80, delaying is almost always the stronger financial move. Your health and longevity projections genuinely matter here, and this is one area where individual variation drives the decision. The actionable takeaway: do not treat Social Security as a pressure valve for a savings shortfall. Use the 12-year window to build assets, keep expenses lean, and let your Social Security benefit keep growing. That combination is worth far more than an early claim. The Roth conversion window: hiding inside your 50s. There's one more strategy that often gets overlooked by late starters, and it matters more than most people realize. If you have money sitting in a traditional 401k or traditional IRA, pre-tax money, you may be in a rare window right now where your income is lower than it will be in retirement, or where you have deductions that offset income. That's a Roth conversion opportunity. Here's how it works. You move a portion of your pre-tax retirement savings into a Roth IRA. You pay ordinary income tax on the converted amount in the year you do it. But from that point on, the money grows tax-free, and withdrawals in retirement are completely tax-free. No required minimum distributions from Roth IRAs during your lifetime either. The Secure 2.0 Act also eliminated RMDs from Roth 401ks starting in 2024, aligning them with Roth IRA rules. That's a meaningful change for people who have Roth balances inside a workplace plan. Why does this matter for someone at 55 with $50,000 saved? Because if your current tax bracket is 22%, but you expect to be in the 24 or 32% bracket in retirement, due to Social Security income, RMDs from a growing traditional account, or other income sources, converting now is paying tax at a discount. Even modest conversions of $10,000 to $20,000 per year over several years can meaningfully reduce your future tax burden without pushing you into a higher bracket today. The right move is to run the bracket math for your specific situation before deciding how much to convert. Your filing status, current income, and projected retirement income all affect whether conversion makes sense and at what size. That's a conversation worth having with a fiduciary. But the strategic point stands. The years between 55 and 65 can be a conversion sweet spot that many late starters never use. Building your 12-year action plan. Let's pull it all together into a framework you can actually use. The first priority is the employer match. If your workplace plan offers any matching contribution and you're not capturing the full match, that's the first dollar to fix. A 50% match on the first 6% of salary is a 50% guaranteed return on that contribution. Nothing in the market reliably beats that. The second priority is maxing your IRA. Roth if your income qualifies, traditional if it doesn't. The 2025 limit is $8,000 for people 50 and older. If you can't max it today, get as close as possible and increase it every time your income rises. Third, push your 401k contributions as high as your cash flow allows, up to the $31,000 ceiling for 2025. Automate the increases. A 1% contribution bump each year barely registers in your paycheck but compounds significantly over 12 years. Fourth, mark your calendar for age 60. That's when the Secure 2.0 Super Catch-Up kicks in. At 60, your annual 401k ceiling jumps to $34,750. Make sure you use it. Fifth, decide on a Social Security strategy before you need the money, not in the moment of financial pressure. Model both claiming ages, 67 and 70, against your expected expenses and other income. Delay if your health and plan allow it. At the end of 12 years, even a moderate version of this plan, not the most aggressive scenario, just a disciplined one, can realistically move someone from $50,000 saved to $400,000 or more. That's not a silver bullet, but it's a retirement that works, especially combined with a delayed Social Security claim and modest spending control. The math is real, the tools exist, the window is open. What matters now is using it. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this framework helped clarify things, subscribe to the channel so you don't miss the next one. And drop a comment below. What's the specific retirement question you'd most like me to dig into? Whether it's Medicare timing, Roth conversion strategy, or something else entirely, I read every comment and I'll work the best questions into upcoming videos. Subscribe so you don't miss it.